let's get into it. Geraldine, thank you for being on the show today.
Thank you for having me, Jack, today to talk about how I can help investors save money on taxes and improve their cash flow.
Great. Tell us a little bit about yourself, Geraldine. Who are you? How'd you get into cost segregation? A little bit of background story.
So, I was born and raised in the San Francisco Bay Area. And the way I got into cost segregation was actually through a good friend of mine who lives in San Diego. When we talked about it, it was over 10 years ago. And at that time, he had been in the industry for over a decade. And so when we talked about cost segregation, I told him I've never heard of it. And he explained to me um, what it is. And I was interested in it because I've never heard of it. And so that's how I got it into the industry. He actually had so much business that he needed help. So he brought me under his wing and was my mentor. And I started with the company that he was with at that time. And so that's how I got into the industry. And I like it because most people, even till today, have never heard about cost segregation,
True.
which is unfortunate because I meet so many real estate investors that have owned real estate for years and they've never heard of this tax strategy. And so they'll think, is it a scam? Is it legit? And cost segregation has been around even since before the year 2000. So if you're listening, this might be a and you're on extension, or it's or you want to know how you can minimize your tax liability in the future. I mean, this is very valuable information. So it's great that you have me here today so that we could talk about it, because there's still plenty of people that are in extension. So if they're a real estate investor and they owe and they want to figure out how they can minimize their tax liability, this will be valuable information for them.
Yeah, that's why I wanted to kind of have you there, because I learned about it 7 years ago, and it was funny. I learned it on my own, not from my CPA, which a lot of people, a lot of CPAs don't actually implement it, which is insane. Especially when you have real estate investors or as your clients. So explain to the viewers what is a cost segregation, and I guess the lamest term of seventh grader knowledge.
Oh, sure. So what I like to do is I'll tell a story. So this is a true story. A real estate investor in Denver, Colorado, called me in the middle of March, and he told me, he said, Geraldine, I have my tax return in my hand, that was prepared by my CPA, and it's ready for me to sign and mail to the IRS along with a check for $100,000. And a friend of mine, who is a client of yours, said to call you to see if there was something you could do. I said, okay. He has 12 rentals in that Denver area, and all single family homes. And I told him to send me some information about these 12 rental properties. So he did. My team and I looked at it, and I called him back and I said, if you don't want to pay a single dime to the IRS, you don't have to. And he said, great. What are you going to do? How are you going to do that? And I said, when you own investment property, you get an annual tax deduction called depreciation. And you're going to get this annual depreciation for a certain amount of time. For residential properties, you'll get it for 27 and a half years. And for commercial properties, you'll get it for 39 years. And I said, what happened in his case is the annual depreciation he got from all 12 properties still left him owing $100,000. So I told him what we need to do is we need to squeeze out more depreciation that he could use for that tax return so that he owes zero. And I told him that we'll do what's called a cost segregation study on these buildings. So a cost segregation study is a detailed engineering report on the building. It literally breaks out that building into every single component used to construct it, right? The four walls, the roof, everything. And it identifies which parts of the building can give you more depreciation than the annual depreciation now to help you lower your tax liability. So inside the building, we're going to find 5-year assets. Those are going to be items like carpet, countertops, cabinets, wall coverings. And outside the building, we'll find 15-year assets. Those are going to be items like asphalt and landscaping. So these were residential properties, but I know to make sure we touch on the commercial properties. So in a commercial property, still be the same thing. Basically in real estate, what this report is doing is it's technically separating the real property,
Right.
what's known as real property, which the IRS considers anything permanently attached to the ground. It's separating it from the personal property, which the IRS says if you wanted to, you could take it with you. Like, would you really take the carpet? No, but if you wanted to, right, you could take it. So with a commercial property, let's say for the outside, we're going to find like in the parking lot, wheel stops, bollards, things like that. Well, anyway, so when you see a cost segregation study, you'll see 3 columns. You're going to see the 5-year property, the 15-year assets, and everything else the IRS says you can't depreciate faster. So you'll see 5-year, 15-year, and 27.5 year for residential properties and 39 years for commercial properties. So basically the report's showing you how you can front load a significant amount of the depreciation you can use today versus having it spread out over 27.5 or 39 years. So in his case, we did do cost segregation studies on all 12 properties. He had the total fee to do those reports was $27,500, but the value proposition is this: would he rather? And that fee is 100% tax deductible.
Okay.
And which is great, right? And the value proposition is this: does he spend $27,500 and write a check to me and my company for that amount, or does he write a check to the IRS for $100,000? So obviously, he like most investors, they're going to want to write a check for the smaller amount, not the bigger amount. So my company did the 12 reports, and he didn't have to pay anything to the IRS.
Wow. That's so basically you front loaded, you got the building, you broke it apart 5, 10, 5, 15, and whatever, if it's a residential 27 or 39.5 for commercial, and the 5 and the 15, you guys were able to front load the depreciation for the client. So obviously he had more of a loss compared to his active or whatever income, and he ended up paying zero other than the cost of your fees.
Right.
Oh wow. There you go. If you guys own, multifamily or, commercial buildings, this is a great advantage or tax strategy to use. When it comes to, let's say we're talking about for multifamily, because I have a lot of multifamily audience and commercial, but when is the best time to do a cost segregation? Because this client you were speaking of, was it on the acquisition, like when he just bought it, or was he towards the middle of 5 years in, 10 years in? Because I have clients, or we have audiences that like myself, I own 2-3 properties, and I didn't know about this until 6 years after owning them, and I'm like, whoa! But I was able to do it, but I just didn't, I the 6 years that were already done, they were done. So
yeah, so the best time to do cost segregation is right after purchase. And with a lot of multifamily investors that I work with, they purchase the property with the intentions of doing significant rehab,
right.
Because they want to increase the rents, right? So if I meet that multifamily investor after the renovation, there may be missed opportunity.
Oh, okay.
And what I mean by that is a lot of times when they acquire the property, it's already rented, right? Typical, these buildings already have the tenant. So in that scenario, if I were to have that conversation with that investor who's about that property, we would talk about doing a 2-part study.
Okay.
Meaning we're going to do a study on the building after acquisition before they do the renovation, so that we could capture the accelerated depreciation on the building as is. And then we would do a study on the renovation to capture the accelerated depreciation on those improvements, right? So that maximizes how much accelerated depreciation they're going to receive and be able to use for on their tax return. Also, the first study that would be done on the building right after the acquisition is it would help with what's called partial asset dispositions. And what that means is the IRS says you can write off the remaining basis of whatever you throw away. If you're replacing the roof, if you're replacing the windows, the carpet, whatever you're replacing, you can write that off. But so when you don't do a cost segregation study, and let's say you do the renovation, right? But there's no cost segregation study involved. Well, then how does you and your CPA figure out what's the remaining basis of whatever you throw away? Like, what's the remaining basis of that carpet, right?
Right.
And so going back to what I mentioned earlier about how the study breaks out the building into every single component.
Mm-hmm.
So on the study, typically, well, at least for my company's report, you're going to see all the different components, right? Windows, the carpet, wall coverings, you're just going to see every line item, right? And there's going to be a value attached to every component. So when you actually throw those items away, then it'll make it easy to calculate, well, what's the remaining basis now when I disposed of it, right? Because otherwise, on a tax return without doing a cost segregation study, all you're going to see in regards to that property, you're going to see two line items. You're going to see a value to the building and a value to the land. Well, if you just see that value to the building, how do you know how much of that value goes to the roof? How much goes to, you replace the
windows.
Yeah, the
or
windows.
electrical, plumbing.
Yeah, electrical, plumbing, like any of the components.
Right. So that's kind of like a double dip, right? You can be able to do if you do a right on acquisition, right? Because you have the building as is, so you get the remainder of whatever is left on the building, and then when you do the new, if it's roof, electrical, windows, whatever, asphalt, concrete, you take that starting on the new. Is it new basis on that because you're putting the
right? So it's added to the basis, and then if you do the study on those improvements, then you can get the accelerated depreciation on those improvements, depending on what it is.
And when you say accelerated depreciation, how much of that can like an investor myself or anybody watching, how much of that can I take it against my active income or whatever, it shows on my tax returns?
So,
or is that a CPA question?
No. So there's a number of responses. So one, it's great if real estate investors know about cost segregation, right?
Mm-hmm.
Because then they know that tax strategy is available. And if they have a tax liability, they know that they should look into it, right? Because it might help them lower their tax liability. Then that's one. And then two, one of the big topics for real estate investors, if they know about cost segregation and bonus depreciation, is the timing of it, right? Mm-hmm. So, for example, if somebody bought a property, let's say they bought like an office building in 2020, but they didn't do cost segregation, and they're listening to this now, they're like, well, I bought it in 2020. Is there a missed opportunity as far as bonus depreciation, right? If they've heard about bonus depreciation. And the answer is no. Because bonus depreciation so back in 2017, the tax laws changed regarding bonus depreciation. And what changed is you got 100% bonus depreciation if you acquired or newly constructed a building, whether it was residential or commercial. You got what's called a 100% bonus depreciation if you've purchased or newly constructed a property after September 27th, 2017, and before the end of 2022. So what that means is, so I talked about the 5 and the 15-year property. Well, instead of waiting 5 or 15 years to get that accelerated depreciation, the total amount of that 5 and 15-year property, you had access to 100% of it immediately. So let's say in that story I told, the 100,000, he did acquire those properties in that time frame. So that's why he was able to completely eliminate that 100,000 in his tax liability
So
because of that.
so hold on, let's get to the viewers out there. So with what you're saying is since 2017 to 2022, you were allowed a bonus depreciation of the cost segregation value that you guys or you or any company came back with. So if it was after doing a study, it was, let's say, in a like an off example, it was $100,000. You were able to take that whole $100,000 and go put it as depreciation against your active income. Oh wow.
So you didn't, because normally it would be spread out over 5 or 15 years,
Right.
but with that bonus depreciation, you didn't have to wait
You
that
didn't have to
amount of
wait.
time.
You can take it right away. Oh,
Right.
see. What about, well, it's 2025 now. What about now?
Well, so it started to decrease after 2022. So in 2023, it started to decrease by 20%. So in 2023, you only got 80%.
Of that. Okay.
And then in 2024, it went to 60%. And then for this year, it's 40%. However, Trump, in his address, said that he's going to bring it back to 100%. And it might be 100% starting just for this year in January. But who knows? Until that becomes law, we don't know what the change is exactly going to be. But
Right.
everybody's hoping that it'll go back to 100%.
But anybody, all the viewers that are watching, you still can take advantage of the 40%
Correct.
taken right now. And then I think next year it'll be 20%, correct? And then it'll sunset in 27.
Right.
So if you or anybody that's watching and haven't done a cost segregation or need some help with your taxes, look into it. Call Geraldine, and we'll give you her contact information at the end of the show. Cost segregation companies. Now, so once I started learning about this, I've seen there's a bunch of companies. What's the differentiation between you guys and your company to other people, or the reports you give compared to other companies?
Well, before you answer that question, I wanted to go back to what we were talking about with bonus depreciation. So investors and commercial real estate brokers will contact me when they're just looking at properties, because since I just explained, we just talked about bonus depreciation, that will come into play on the property that they acquire. So for example, going back to when I was talking about the tax return and how, without doing a study, you'll only see a value for the building and land. So when you buy property, you're buying two things. You're buying the building and the land, right? Mm-hmm. So it's really important how much. So the building is depreciable, right? That's what gives you depreciation, not the land. Land's not depreciable. So it's really important, the value of the building, because, in certain areas, on property tax record, you see, let's say in San Francisco or downtown LA, right? You'll see 50% of the value, according to the property tax records, goes to the building, and the other 50% will go to the land. Well, if you chose a different area, let's say the property tax records show 90% going to the building and only 10% going to the land. Well, you get more depreciation if you bought that property, right?
Right.
So, so there's different factors that go into play. Bonus depreciation, obviously, it's great that it's available, right?
Right.
But that's another piece of it, right? So that's why it's important, if you know about cost segregation, if you're thinking about cost segregation before you purchase the property. So anyways, my point being is that a lot of commercial real estate brokers and investors will contact me to run some numbers even before they acquire the building, because they want to make sure that if they are going to consider cost segregation, that it'll help them figure out which property they may want to purchase.
Right, because you can't depreciate the land.
Right.
Right. So if there's more percentage going to the building, you want it over this building, you want to take care of that. You might want to purchase that building for the bigger cost segregation.
Right.
Okay.
And Jack, we met through CCIM, and one of the instructors that teaches cost segregation up in Northern California. He said that when he teaches about cost segregation, he explains how some lenders, let's say they require 30% down. So if you are looking at $1 million building, then and you have to put 30% down, that's 300,000, right?
Mm-hmm.
Well, when he brings up, so especially in this market today, and interest rates are high. So what he explained is that, okay, so you have to put 300,000 down, but if you do a cost segregation study, which on average moves anywhere between 20 to 40% of the building basis into a faster depreciation schedule, let's say you're able to get 30%, right? Which is what you put down for the financing, right?
Right.
Well, if you do a cost segregation study and this report gets you 30% in accelerated depreciation, then you've recouped
All your down payment.
your down payment. And so when he explained that to the class, and because a lot of commercial real estate brokers are investors themselves,
Correct.
then it changes their strategy on what properties they're going to acquire. So it's a different lens that they use when they look at properties. Anyways, I wanted to share that because
I mean, that's my brain's working right now. I'm thinking about it too. I'm like, wait, what? Hold on. You can put 30% and get the depreciation on that, so you basically got a free property. Kind of, right? Yeah.
Yeah. So that's a strategy that's a way that a lot of investors that I know, that's how they look at properties when it comes to the financing and knowing that they're going to look at cost segregation if they were to acquire that property.
That's interesting. I mean, thanks for dropping that knowledge. Now my brain's going crazy. I'm thinking about that because obviously I'm an investor as well, and I'm in an exchange right now, so I'm thinking of a new property. So I'll have a conversation with you regarding that. Before we go to that question I asked you, cost segregation, is it? We know it's in the IRS code. This is not no magic thing or loophole or it's the illegal thing you can do. Is this for can anyone do this, or is there like a catch to it to do this?
So anyone can do it. It just depends on their tax situation and whether it would work for them. And what I mean by that, like, I just got introduced to a couple of investors in that own a portfolio of hotels. Well, they don't have a tax liability, right? So there's no reason for them to look into cost segregation because they don't owe. This strategy is for specifically real estate investors, and if they know they're going to owe for the current tax year. What was your question again, Jack? Tell me again. Sorry.
What is it for anybody can do this, right? There's no specific classification or anything that you need. Like, we have the audience here, mom and pop investors or syndicators or anything like that. Anybody can do this, right?
Right. Anybody can do this, and it can be done on any building. There's a lot of misconception out there that it can only be done on commercial properties, and that's not true. It can be done on both residential and commercial properties. And sticking on the residential side, it can be done on an ADU. It can be done on either a residential or commercial condo. It can be so on that story that I was sharing about the investor in Colorado, he acquired those properties by doing house hacking, where he acquired a single family home, lived in one of the rooms, and then rented out the other rooms. And when the property started cash flowing, he would move out, rent out the whole house, and then repeat that process. And then on the commercial side, I'll share this story. In the Bay Area, I was introduced to a real estate developer, and this was after his project was done. He was able to build a commercial building out of shipping containers.
Okay.
And so he made 30 spaces. Now, the $1 million question is, how did he attach those shipping containers together? And did he use nuts and bolts, or did he weld them together? And he welded those shipping containers together by welding them because it cost less. Okay. So now, if I was part of the tax planning process and we had this conversation, that may or may not have changed his decision to weld those shipping containers together. But the But what we would have talked about is if he did decide to use nuts and bolts, he would have gotten a ton in 5-year property, right? Because according to the IRS, like what we talked about earlier, you could
Take the nuts and bolts. Yeah, with you.
you could
Okay.
take them apart. But because he welded them together, all that 5-year property is missed,
Oh, wow.
right? So
Mhm.
but like I said, because of cost, that may or may not have changed his decision to weld them together.
Well, depends, right? Because if you can got the cost segregation and got that back on the tax side, we could have would have been equal or who knows, right? But
Right.
okay,
Just like the example about like,
yeah.
okay, 30% down, but if you do cost segregation, you might get that 300,000 back, right? In the
So if someone's doing a development, it would be great to have this conversation pre-hand, right? And your company can help with like kind of, well, here's the plans, here's what we're using. What do you guys think? Or you guys can, give at least a little guidelines of like, hey, maybe use this material. We can, segregate more here, or take a little bonus advantage here, or stuff like that, right?
Absolutely. So my team and I have conversations with builders and developers all the time. So for example, um, so I have a client that is interested in building a brand new storage storage facility, right? And so we had a conversation on what assets would qualify as 5 or 15-year property so that he can get an ideal, right, in the design phase, you know what type of tax benefit he would be looking at if he were to do a cost segregation study, right?
Mm.
We're not having this conversation after the fact. We're part of the planning process so that he can figure out like what am I going to put in this self-storage facility in order to get more bang for my buck if I'm going to do a cost segregation study. And the same goes like for, let's say, for a mobile home park.
Hmm.
Now I'm switching to that property type. You know, uh, clients of mine that own those type of properties will wonder like we're not looking at the building, right? Because it's just mobile homes, and a lot of times these investors they don't own the mobile home, right? The people are leasing these
Hmm.
spaces, right? But what we're looking at is the 15-year property, what you'd find outside of a building,
Oh, okay,
right?
yeah.
So then that's a completely different conversation because now we're talking about all the different 15-year assets that we would typically find in a mobile home park.
No.
So, yeah, depending on the property type, that's going to determine what we're going to find inside the building or outside.
When you said you can use this for residential property too, it's rentals, right? Not your primary resident. Okay.
Right. So it's not, um, yeah, it can't be done on a primary residence or a vacation home. It has to be an investment property.
Okay. Well, I mean that's a lot of property then. With all the audience that are watching, if you haven't taken advantage of a cost segregation with any of your property, even if you owned it for 5, 6 years, you can still take advantage at least of the 15-year cost segregation, right? On that, if someone owned a property, one of the viewers, they're in year 8, can they still do it?
Right. They can still do it. What you want to keep in mind is, yeah, how long you've owned the property. Like if you've owned it for 20 years, let's say for a residential property, right? You own, a 9 unit,
Mm-hmm.
then you only have 7.5 years left of depreciation on the table, right? So there's not that much meat on the bone, and then, I have clients here. We're in Southern California, right? And
Mm-hmm.
so, I have a lot of clients who own multifamily properties here in Southern California. And when they got introduced to me and we had this conversation, because they never heard about cost segregation,
Mm-hmm.
right? They said, Geraldine, I bought these properties back in the 80s. They're fully depreciated, but I miss that depreciation, right? And but then when they learned about how they could get that accelerated depreciation, they not only do they want that depreciation, they want the depreciation that they used to have, they want that accelerated depreciation to help them lower their tax liability. So that's when they'll talk about doing they'll do a 1031 exchange to get a new multifamily property so that they can get the depreciation, but specifically the accelerated
Mm-hmm.
depreciation to help them lower their tax liability.
Well, the multifamily 5 plus, they're considered commercial, but are they when they're done, are they 27 and a half years or 39 and a half?
So 27 and a half.
Because the resident, it doesn't matter how after, even if it's 9 units or 15 units or
Right.
30 units.
Right. So, when it comes to taxes, it's 5+ units is unlike the real estate space. In the tax space, it's considered residential property. But of course, in the real estate space, 5 units or more is considered commercial. But for tax purposes, it's considered residential.
Okay, that's cool. That's good to know.
And then sticking with that, because so this cost segregation is for any investor, residential or commercial. And everybody has different tax situations, right? So the way the cost segregation studies results are applied is you for someone that's not considered a real estate professional by the IRS, you're a W-2 employee, right? I get a lot of doctors,
Mm-hmm.
right, that own real estate. And so they have this passive income, right? But they have a six-figure income, 7-figure income. And so they pay a lot in taxes. And so for them, the way the cost segregation study results would be applied is to their total passive income, right?
Mm-hmm.
So if they have a cash flowing property, then that's where those results are going to be applied from the study. It's not, unfortunately, unless the tax laws change, it's not going to be applied to their wages, right? Because that's really what they're looking for when they do a cost segregation study.
Right.
But there's something called the short-term tax treatment. Have you heard of it, Jack?
Well, I'm about to.
So a lot of CPAs, if they know about it, and if their clients that are investors know about it, but just like cost segregation, a lot of people aren't aware of this short-term tax treatment. So if you, and also a lot of people don't have the appetite for short-term rentals, right? Airbnb, VRBO, right? They want a long-term rental. They just want someone to sign a long-term lease and be done
Right.
with it. Well, anyways, but if you do a short-term rental like Airbnb and VRBO, if you can qualify for the short-term rental tax you may qualify for the short-term rental tax treatment. And what that means is, instead of it just being applied, the results of the study being applied to the total passive income, it can be applied in that scenario. It can be applied against their wages. But again, you have to be doing not only short term, but there's a certain criteria that you have to meet. But anyways, that's a way to have it applied to the wages.
Okay. I think we went through a lot of tax stuff and tax planning, and because again, I'm not a tax planner. I'm not a CPA, so all of this stuff are just insights of. But go with your CPA and have these conversations with them, and see what strategies you can implement to your tax strategies or to help you out.
Yeah.
I guess go back to the other question I asked you regarding cost segregation companies and reports. So I've talked to a lot. I met you through CCIM, and I got to know you a lot, and your company and everything. And I'm comfortable with you, but I've also know other companies and different reports. I'm with clients that have done it before. Like, hey, I got this report. It's just 2 pages, and I'm like, okay. And after I met you, you're like, wait, ours is detailed, Jack. We're like, we go like 10, 15 pages, and we cite court stuff and everything like that. So cases that why this item is allowable. Can you explain? Get into more detail about not saying just to choose your company, but just what to investors to look out for when they choose a cost segregation company.
So absolutely. So not every cost segregation firm provides the same type of report. So like you said, some companies, they'll just provide you with one page and it's just going to give you some numbers that you can use for your tax return. Well, I have a lot of clients that are concerned about being audited, right?
I think everyone.
Yeah. So my company, we do a physical inspection with all of with each report. And there are two reasons for that. One, we provide an audit defense at no cost up to 8 hours. And so because of that, we physically go to the property to take pictures, notes, and measurements that become part of the report. So if the IRS has any question, let's take a commercial building, for example. Oh, there's an elevator. Is there? So we're going to have a picture and we're going to have the details on
Right.
that elevator in a commercial building, right? So, and we do that just because if the client is ever audited, and I've had not a lot, very few in the 10 plus years I've been in the industry that have been audited, but because we have a detailed report, I have yet to have an IRS agent request any changes to be made, right? So that just goes to show why we want to have a detailed report, because if the IRS agent has any question, we can answer it. Also, the other reason why we physically go to the property is because the client's paying us to identify every single component that can provide them with more depreciation. And without physically seeing the property, we would have no idea that's there. Anyway, so that's one difference between me and a lot of other companies. And also, it depends on the knowledge and expertise of the firm. So, for example, the founder of my company, he has an extensive background in cost segregation. He was in charge of the cost seg group for Moss Adams, and then he went to KBKG, right? That's another big outfit. And so he has a lot of experience and knowledge in cost segregation. Also, there is an organization called the American Society of Cost Segregation Professionals that set the bar, set the standard for what cost seg firms should adhere to. Not only do we follow the IRS's guidelines regarding cost segregation, but this group, they make sure that the firms associated with that group adhere to a higher level of a higher standard. So the founder of my company, John Hanning, is on the board of that group. And also you can get a certification through this group as far as cost segregation is concerned. And all of my engineers on my team all have that certification through this group. And it's just like when you become a CPA,
right?
Right? You got to go through these tests and pass and coursework. So, and the reason why I'm sharing that is when I met a multifamily investor who's here in Southern California. So I met her, she's heard about cost segregation. So when she saw a presentation that I gave, my team and I was able to look at some reports that were done by another cost segregation firm. And one of the reports they did on one of her multifamily properties, they only moved 13% of the depreciable basis into a faster depreciation schedule. My team looked at that report and said they missed a lot that she could have gotten in electrical and plumbing. So we would have gotten her 33%. That's more than half that was missed. So, and when people ask me about that, it just depends on the expertise and knowledge of our team, right? Because we're following the IRS's guidelines on what they say can and cannot be put on a depreciation that can be depreciated faster. So that's huge. I mean, especially if you're paying for it and you're looking for how much you can get in accelerated depreciation.
Oh, sounds good on that. I know there's a lot on there, but I'm from hearing all you and knowing from you and meeting you and knowing all that, I know that you guys do a very thorough job when it comes to cost segregation. If any of the viewers would want to get a hold of you or, might want to see what their building might qualify for, how would they get a hold of you or get in reach with you?
So I can be reached at the phone number 510-386-0872, or they can email me at geraldine.serrano@specialtytaxgroup.com. So it's Serrano at specialtytaxgroup.com.
Any social handles? Are you on
Oh,
LinkedIn?
yeah, I'm on LinkedIn. So you can easily find me on LinkedIn. And if you wanted more information, you just go to specialtytaxgroup.com and you can get more information about me and my company. Our bios are on there, the different services we provide, because we don't only assist with cost segregation, we definitely help out with another tax deduction and other tax credits that are available to other individuals and companies.
Oh, that's good. Thank you, Geraldine, for being here and dropping all these nuggets for us and giving us insights on the cost segregation part of it. And to the viewers, if you like this episode and like to learn more about Geraldine, please give her a call. And if you like what you heard here on this episode for Multifamily Insights, please feel free to subscribe and hit the like button. We'll try to bring you more insightful knowledge to help you with your multifamily and investment journey. Till next time, this is Jack Patel, and we'll see you on the next one.